Welcome to the Friday Market Wrap. I am your host, Peter Schiff. I hosted the Market Wrap last Friday. It seemed to go pretty well, so I thought I'd do it again. But as I mentioned on the last week's episode, this is going to be the last time I do it for a couple of months because I leave on Monday for my summer vacation. The first stop is going to be Las Vegas for the Bitcoin conference, otherwise known as Fool's Gold. And I will be speaking to 30,000 fools, although some of them are pretty wealthy fools if they bought Bitcoin a long time ago. But the ones that keep holding it or hodling it are going to end up losing a lot of money. But I don't want to talk about fool's gold. This podcast is about the real thing, actual gold. And gold had a very strong week. Gold rose over 5% on the week, about 5.25%. We settled at around $3,358. Silver also didn't have a shabby week, up 4%. Eventually, I expect silver to outshine gold, but still, it's not doing it yet. Silver closed almost at $33.50. So that 100-to-1 ratio is pretty much intact right now. You could buy 100 ounces of silver for 1 ounce of gold. The dollar got beat up pretty bad this week. Dollar index dropped about 2% on the week, settling just above 99. 10-year and 30-year treasuries got clobbered. Yields on the 10-year settled just above 4.5%. And on the 30-year, we settled above 5, I think about 5.03. The high we got intra-week was 5.15, I believe, on the 30-year. The 10-year got to 4.62, I think, before we got a little bit of buying. But I expect new lows probably by next week in the bond market. Stock market also was down. S&P 500 slipped about 2.5%. So it was pretty much a sell America week. U.S. stocks went down. U.S. bonds went down, the U.S. dollar went down, and gold and silver went up. Now, there were two primary catalysts, I think, for the Sell America trade. One was the House passing the Big Beautiful Bill, which is big, but it ain't beautiful. And because it's so ugly, I think that's one of the reasons that we got the sell-off. And of course, when I did my last market wrap on Friday, I recorded it before Moody's downgraded U.S. government debt one notch. Moody's now being the third credit agency. Standard & Poor's started it years ago, and then Fitch did it, and now Moody's. So all three of the credit agencies have downgraded the U.S. government debt from AAA, but it's still overrated as far as I'm concerned. But that announcement came out after I finished the market wrap, and so I wasn't able to discuss it. But now I can mention it this time. So that's what got the week off on a bad note, right? Because Monday was the first day, or Sunday night actually, was the first time traders had the opportunity to react to the downgrade. But really, it shouldn't be news. I mean, the U.S. government clearly can't repay its debt in any legitimate manner, meaning we can't repay it in dollars that have the same purchasing power as the dollars had when creditors loaned the money. So, it's almost like default is inevitable on treasuries. So what's the point in even rating it? The question is, how are you going to lose? Because loss is guaranteed. So you're either going to lose because we default, and the risk of that is there. It's not negligible. There is a risk. It's certainly not risk-free. And so the only mistake that Moody's made, other than waiting too long to downgrade U.S. credit, was they didn't downgrade it enough. But either the U.S. government defaults or it inflates, meaning that either you don't get your money back or you get your money back, but you can't buy much with it because you don't get your purchasing power back. So either way, if you loan money to the U.S. government, you will lose. So really, Moody's wasn't telling anybody something that they shouldn't have already known. But, kind of like, the emperor has new clothes. I mean, somebody says something and then it prompts a reaction. So I think that started the dollar's troubles, but the dollar and the bonds rather too. But the trouble continued as the House passed that big, beautiful bill. Because I think when Donald Trump was initially elected, there was a lot of false optimism out there about fiscal responsibility, about cutting government spending, especially with the introduction of DOGE, the Department of Government Efficiency, really an oxymoron, but head by Elon Musk. And so there was a lot of publicity around all these cuts, and we're going to cut trillions of dollars out of the budget. Now, I never believed this. I was skeptical from the beginning, and I said so on my podcast that I didn't believe that we were going to get all these cuts, that we would get some, but it wouldn't really be enough to move the needle, and that people were making, much ado about what would amount to nothing. And when we got this budget, right, the budget dramatically increases the debt. In other words, as a result of the big, beautiful bill, the debts will be higher. The budget deficits every year will be higher than what they would have been without the bill. So the bill doesn't cut anything. Now, yes, there are a lot of Republicans that want to talk about the Medicaid cuts or the SNAP cuts. These are not real cuts. These are phony cuts because they don't take place for another 5 years. That's when they start to kick in. Well, who the hell knows what's going to be here in 5 years? It's going to be a different Congress, going to be a different president. What are the odds that a new Congress and a new president don't repeal those cuts before they ever have a chance to take place? I mean, this is par for the course when it comes to government. They always vote for spending cuts that don't happen until many years into the future. So they don't have to deal with the consequences of the cuts right now. But when it comes to the tax cuts, oh yeah, not only do they happen right now, they're retroactive to the beginning of the year. So the government wants to cut taxes right away, but they don't want to cut spending for another 5 years, which means they don't want to cut spending. Because if they wanted to cut spending, they would cut it right now. They wouldn't wait 5 years. They would just make the cuts start this year. At the worst, next year, 2026, right, January 1st. But the fact that they don't kick in until after Trump is no longer president, right, that tells you that they're phony. But meanwhile, the Democrats are accusing the Republicans of gutting Medicaid when they're not gutting anything. I mean, there's a lot to criticize in this bill, but Medicaid cuts is not one of the things that you would criticize. In fact, two of the only Republicans who had the courage to vote against this monstrosity pointed out that there are no cuts. So if we're going to cut Medicaid and we're going to take heat from the Democrats, let's actually cut it. Let's not just pretend to cut it, because the Democrats aren't going to pretend that we cut it. They're claiming that the Republicans cut Medicaid. So they're taking the heat for cuts they didn't even make, right? So this bill is a complete fraud. You got the president of the United States bragging about how significant this bill is, the most significant bill in the history of the country. The only thing significant about it is how much larger it's going to make the deficits. So the bond market realizes, if they didn't, that we were not serious about the debt, that the debts are going to grow 2-3 trillion a year at a minimum, probably going to be much bigger because the economy is going to be much weaker and inflation is going to be much stronger. So their foreigners are selling their U.S. bonds, they're selling their U.S. dollars, and they're selling U.S. stocks. And they're just bringing their money home. They're investing in their own markets. And what are the central banks doing with the dollars that they're selling? Well, they're buying gold. That's obvious that they're buying gold, right? And they're going to continue to buy gold into new highs and then at higher levels because they have to get rid of their dollars. They know that, right? We've made that clear. And in fact, if there was any doubt, we just got a re-escalation of the trade war that was just de-escalated, right? Trump agreed to lower the tariffs that he imposed on Chinese goods coming into America, right? Because that was 45%, right? So we dropped those down to 30%, right? And that was a relief, and we got a rally in the market. Gold sold off on that, right? Well, now, early this morning, out of the blue, Trump puts out on Truth Social that, the trade talks aren't going anywhere with Europe. I mean, I thought everybody was lining up to kiss his ass. Now, all of a sudden, we're not getting any progress. And so Trump said, I'm going to propose 50% tariffs on Europe. Now, of course, he doesn't mean on Europe. He means on Americans who want to buy European products, but he never frames it that way. But he said he's going to propose 50%. I mean, propose it to who? I thought he's the one that decides. I mean, is he going to propose it to them? How do you propose 50% to the Europeans? It doesn't make any sense. So I don't know what the language meant by he's going to propose it. He's going to propose it to himself. He's going to propose it to Scott Bessent. Hey, Scott, why don't you negotiate from this perspective? Now, I don't know. Maybe Trump is just trying to manipulate the markets, because the minute he put that post, stocks tanked, crypto tanked, right? All the risk assets went down. Gold immediately went up. Gold was already up before that announcement. Gold was up about $40, and then it was up about 60. I think it closed up closer to $70 on the day, but it was already up 40 even before Trump escalated the trade war with Europe. But he's really not warring against Europe. He's warring against Americans, because all of his cannons are pointed at American citizens, because it's Americans who pay the tariffs. I mean, it's ridiculous that Trump is getting mad at companies like Walmart for raising prices because he raised their costs. I mean, how could they not raise prices? I mean, they have to. They have to pass on the tariffs. That's what tariffs are. They're an indirect tax. They're a tax that the consumer pays indirectly when they buy products that are subject to the tariff, just like a sales tax. I mean, don't companies pass on the sales tax? Of course they do. They add it on right on the top. The companies don't eat the sales tax, so why should they eat the tariffs? It's the same thing. And again, of course, the purpose of a tariff, of a protective tariff, is to reduce the consumption of imports. And the goal is that consumers will buy domestic products instead. Well, what is the mechanism that causes that behavioral change? It's prices. Tariffs make the price of imports go up. And because imports are more expensive, Americans buy fewer imports. They look for domestic alternatives to avoid the tariff. So in order for the tariff to work, the retailer has to raise the prices. If the retailer doesn't raise the prices, then the consumer's not going to stop buying. And so the trade deficits are going to go down. So, I mean, Donald Trump talks about how much he loves the word tariff, right? Oh, tariff is the most beautiful word in the dictionary. It's my favorite word. Maybe because he doesn't even understand it. He doesn't know what tariffs are. He doesn't know what they do. He doesn't know who pays them, right? He thinks it's all external revenue. He thinks it's a way that, America can go and pick the pockets of the rest of the world to pay for our government spending. Well, that's not the way it works. But this was a big wake-up call this week to the markets that there is no fiscal discipline in the U.S. Inflation is going to run out of control. It's only a question of time until the Fed caves and not only starts cutting rates, but goes back to quantitative easing. Because I believe if the Fed cuts rates and doesn't go back to QE, the long end is going higher. So instead of a 4.5% 10-year, we have a 5.5% or 6% 10-year. And instead of a 5% 30-year, we have a 6%, 6.5%, 7%. These rates are going much higher. And that's going to weigh heavily on the economy. It's going to make the debt that the big, beautiful bill is already increasing that much bigger. Because now all that existing debt and all that new debt has to be financed at an even higher interest rate. Remember, trillions and trillions come due every year of that debt. And most of that debt that was taken on, 3 years ago, 5 years ago, 7 years ago, 10 years ago, even then, it was borrowed at much lower rates than what exists today. So the costs of servicing the debt keep going up. And if the Fed cut short-term rates and the long-term rates rise, that's going to force the government to keep refinancing at the short end of the curve. And that's going to increasingly shorten the average duration of that national debt. The shorter the duration of the national debt, the bigger the potential problem. Because eventually, when the Fed is really forced to try to put the inflation genie back in the bottle, the alternative being hyperinflation, now the Fed has to go medieval on short-term rates. Well, the government is completely vulnerable because now all that debt starts to mature. When Paul Volcker had 20% interest rates in 1980, 81, yes, it was bad for the new debt, but the existing debt wasn't affected because the national debt was all long-term debt. So it didn't mature into that environment. But when we've got a national debt financed with Treasury bills, and more of that debt is going to be in Treasury bills because of the yield curve steepening, we are in for a world of hurt when the Fed finally has to do something about inflation instead of just pretending to do something, which is all it's done over the past several years. Because for all the talk about tight money, we never got tight money. Gold told you that the Fed was too loose. The whole time the Fed was tightening, gold was rising. If the Fed was really tight, gold would go down, right? But that never happened. If the Fed was tight, credit would have contracted. Household debt would have come down. Instead, it blew to record highs. If people are borrowing money in record amounts, what does that tell you about credit? It's too easy. Look at government debt. The government deficits exploded. That doesn't happen in a tight money environment. Tight money is tight credit. Inflation is an expansion of the money supply and credit, because credit is like money. You don't need money to buy stuff if you have credit. And so as people have access to credit, they can bid up prices. So what the Fed has to do to fight inflation is not only shrink the money supply, which is now growing, it's not shrinking, but they have to shrink credit. And even though money supply contracted a bit before it started to re-expand, credit never contracted. Credit expanded the entire time the Fed was pretending to tighten monetary policy. So the whole inflation fight was a lie. The Fed basically surrendered before the fight even started, and inflation won. And now it's going to do a victory dance. But this is what is prompting the exodus from the dollar. And I think the dollar is looking very weak going into next week. It could drop even more precipitously, as this big beautiful bill works its way through the Senate. And who knows, they may even make it worse. I doubt they're going to make it better, right? But it's hard to imagine it getting any worse. But I wouldn't be surprised, because that is the direction that we're headed in. And maybe this trade war, this renewed European war, will escalate. So I think that next week should be a pretty strong week for precious metals. In fact, we had a big boom in platinum and palladium. In fact, we had one day a couple of days ago, like platinum prices were up 5%, now back over 1,100. I mean, platinum is still really cheap. You're buying basically 3 ounces of platinum for 1 ounce of gold. So I think platinum is a good buy right now too. I mean, we haven't really been talking too much about platinum, but I think these white precious metals, platinum and then silver, I think they're gonna start to catch up. It hasn't happened yet, but that big spike now in platinum and palladium, maybe the whole precious metals complex is about to move. So it's not just gold. It's not just central banks buying gold because they're getting rid of their dollars. I think all the precious metals are going to be moving because of inflation, because of a broad-based inflation threat, de-dollarization. That process is going to accelerate, I think, in the weeks ahead. So my advice, as you're, listening to the market wrap, as I said last week, is just buy. Do not wait. Do not get cute. Do not hope for a pullback. The pullbacks will be short and swift, and the chances are you'll miss them. So I would just buy, especially, look, the silver, you've had this gift horse opportunity, silver hanging out in the low 30s, $33.50, something like that. Once we get through 35, Katie barred the door. I think we're making a beeline for 50. And then we probably will have a little bit of resistance at 50. But you don't want to buy it at 50 when you can buy it at 33.5. But I think once we get through 50, it could be a quick trip to 100. And of course, gold's not going to be at 3,400 when silver's at 100. Gold's going to be a lot higher too, but percentage-wise, I think that silver will gain quite a bit against gold. But whatever you want to buy, whichever precious metal, the sooner you buy it, the better, because the longer you wait, the more expensive it's going to be. By the way, I did the first SchiffGold webinar for SchiffGold customers earlier today. I think it went pretty well. So, first time I did the weekly Friday market wrap, and now I did a webinar. So if you missed the live webinar, and I was able to take questions, and so the next time I do one, if you want to ask questions, you can participate in the webinar. We sent out an email blast to the SchiffGold customer base, but we do have a recording, and we're going to post the recording of the webinar, and I'll probably drop a link in the description or somewhere in this video. And so if it's not up like immediately when you first watch it, just check back, because it's going to get up there. And so, or I think we'll also probably have it on the SchiffGold website. But the purpose of that webinar, the reason that I put it together, was I know there were some questions, SchiffGold customers, because there were some changes to SchiffGold recently. There were some emails that went out, and maybe they raised some questions that they shouldn't have. And so I just wanted to put everybody's mind at ease, let everybody know exactly what's going on at SchiffGold. And I also let people know about some of the plans I have to expand the business and to really take it to a new level, especially when it comes to gold, and using gold not just as a store value, which is the primary purpose of SchiffGold customers now. They're owning gold to store value, but to use gold for what it's supposed to be in the financial world, and that's as money. And one of the functions of money is that it's a store of value, and that's why the dollar, is not good money. In fact, the dollar isn't money at all. It's currency, but it's fiat currency, which is the worst kind. But in addition to being a store of value, money should be, or needs to be, a medium of exchange and a unit of account. Gold is an excellent medium of exchange and a unit of account. It's just that we haven't been using it for that purpose. Well, I am going to help our customers reintroduce gold into their lives and use it in every manner in which it's supposed to be used. So as a medium of exchange, as a store of value. So I talk about my plans to help build out that infrastructure and that ecosystem by using the SchiffGold platform and greatly expanding it, and making gold, and using modern technology to bring gold into the 21st century, and to make it a better medium of exchange, a unit of account, than it's ever been. Even when we were on a gold standard, we didn't have the technology that we have today. And so because of the technology we have today, we don't need to wait for the government to reinstitute a gold standard. We can institute it for ourselves. We can put ourselves on a gold standard and debank from the fiat system, yet still have complete and seamless integration with that system, yet maintain our own savings in real money, and then be able to transact in that, both ways, sending and receiving real money, rather than fiat, and having to risk the tremendous loss of purchasing power that is obviously coming to holders of dollars. That's why the international community is already acting. That's why foreign central banks are already moving out of dollars and into gold. And it's only a matter of time before the public catches on and follows in their footsteps. Anyway, that's it for now. And again, I'm not going to be doing more of these SchiffGold wraps until I get back from my vacation, but I will still be doing some podcasts on my regular YouTube channel. So if you're not following me there, go to my YouTube channel, the Peter Schiff channel, the Schiff Report. If you're not a subscriber, subscribe. By the way, if you don't subscribe to this channel, I noticed that we got more than twice as many people who watched last week's market wrap as who subscribed. So if you're not now a subscriber to this YouTube channel, when you finish this video, make sure and subscribe. and then you'll get immediate notice when I do my next one. And you can put a comment there. You can like the video, and I do go back and I can reply to some of these comments. And also, if you're not a subscriber to my main YouTube channel, then go there, a Schiff Report, and subscribe to that one, because I will be doing quite a few podcasts there between now and the time I'm back here doing more market wraps for SchiffGold. Anyway, bye for now, and I will see you when I get back.